Harsha, taking that point forward itself in terms of macros and the kind of concerns that we're seeing there, markets seem to have somewhat ignored that to a certain extent, because you're still talking about levels of roughly around what, 6,000 on the Nifty. You got Sensex hovering around 20,000 level itself. So the question here is, how much more headroom is probably there in this market in terms of upside from here? And also the fact that in terms of concerns right now, well, are returns somewhat concerning, because a lot of investors seem to be complaining that there's total lack of returns in this market.
You are right. The markets have been quite resilient despite macroeconomic challenges. But I think that resilience is coming because of the fact that at lower levels there is valuation comfort. Even today, when we are at 6,000 levels, while we are at 20,000 Sensex, the valuations are not same as what it was in 2008 or probably even 1 year earlier. We are today probably 35–40% cheaper than what we were at 2008 valuation levels. And also, if you look at current valuations of about 14.5 times 1 year forward, that is clearly well below long-term averages in terms of valuations. And also, if you look at within the sectors, if you take aside defensive sectors such as FMCG, IT, pharma, rest of the market is actually quoting at about 10 times on 1 year forward earnings. So clearly there is value in that segment, but the issue there is the earning stream is not secure, the growth is suspect. So you can't have your entire portfolio built around those baskets. You have to have a balance between defensives as well as those cyclicals where you see some amount of stability. And as things progress, I think one can start adding some of those cyclicals at various levels.